The Wyckoff strategy, one of the most discussed strategies in the trading space right now.
Keep your damn mouth shut.
And there's a reason for that because of how well they work in the market. But not all accumulation or distribution are well identified, for instance. This accumulation didn't make a reversal, and this distribution worked perfectly. So why did this distribution work and this accumulation didn't? Some secret techniques are actually used to identify valid accumulation and distribution in the market, and once you add this technique to your arsenal, you'll instantly see your accumulation and distribution become more accurate. First, we must go over what an accumulation or distribution is. Accumulation refers to the process of gathering a large position in a particular asset, while distribution refers to the process of selling a large position in that asset. Hence, accumulation identifies as bullish, while distribution identifies as bearish. You can mark an area of accumulation or distribution by identifying trend turning points. If you look at your charts, you'll see these turning points everywhere. Oftentimes, when price gets to a trend turning point, it starts to consolidate, and in the process it forms accumulation or distribution, leading to the beginning of a new trend, which we can use to our advantage and profit off this move. But if you've ever traded accumulation and distribution before, you'll quickly notice it doesn't work 100% of the time. This is because you've probably traded an invalid accumulation or distribution. But what makes an accumulation valid? Well, there are 4 key factors that need to be present before it's validated. The first key factor to make sure an accumulation is valid is that the previous trend must have gotten to its climax. After a trending market gets to a point of exhaustion or its climax, it will start some form of consolidation, which will create equal highs or lows, indicating that the trend has come to an end and that a reversal is going to happen soon enough after the consolidation. The first bounce of this equal low is known as the selling climax. That leads us to the second key factor that needs to be present before an accumulation is validated. The second key factor to ensure a valid accumulation is by looking out for a spring. Towards the end of the consolidation, this spring can also be known as a bear trap, because the idea behind a spring basically is about misleading sellers to think the trend is about to continue when it's actually about to reverse. And with this reversal comes the third key factor that needs to be present before validating an accumulation, which is a breakout in the trend reversal direction, known as JAC, and that's an abbreviation for jump across the creek. Now, when this happens, price breaks the equal high and indicates more buying power, which means the new trend is here, and you can look to join the new trend at the new point of support. With this breakout, we have our fourth key factor, which is the pullback to the broken equal high, known as LPS, last point of support. Now, this is basically an entry signal to join the new trend while having a smooth entry. Now, with distribution, it's basically the same concept, only that different terms are being used. I mean, terms like buying climax, which is the opposite of selling climax, UTAD, upthrust after distribution, which is the opposite of a spring, FTI, fall through the ice, which is the opposite of JC, jump across the creek, and LPSY, last point of supply, which is the opposite of LPS, last point of support. Here's a live trade example of an accumulation. We can see the selling climax, spring, jump across the creek, and the last point of support for a great entry, and then boom, money is made. Combine all 4 of these steps together and you'll instantly see your accumulation and distribution performing better. I hope you got some value from this video. See you next time.